Interest rates are finally reverting to normal, or some sense of normalcy. And whereas that's related to all sorts of things going on in the economy, for savers, that's great news. Now the question is, what's the best harbor for your cash today? Hello, my name is Paul Carroll. I'm the CEO and founder of Avion Wealth, an elite wealth management firm here in South Texas. As you probably are aware, if you've got a pulse, everyone's talking about higher interest rates. After years and years of sub 1% returns, all of a sudden we see 3.3, 3.5, 4. But with interest rate hikes not yet over, let's talk about what the options that are out there. And keep in mind that all choices come with trade-offs. There's no such thing as a free lunch when it comes to this treacherous field. So when we're trying to figure out what to do with cash, we have a lot of interesting options. In summary, there'd be banks, money market mutual funds, ultra short-term bonds, and CDs. So let's go over to the board and take a look at how these options pan out. So let's talk about the different cash options available. First, we've got the banks. And the best banks are the ones with credit cards because they've got an immediate use for the money. They don't need to give it to a third party, worry about the collection. I like American Express. They're paying 3.5%. Now, this is rotating. Well, Capital One will be the top bank 1 month. Another bank will be Chase. I really like Amex for a number of reasons. One, it's a really easy setup. Two, they don't send an army of salespeople after you to sell every other single product that their mega bank sells. So Amex is a great product at 3.5%. Then we've got what we call money market mutual funds. And those things are a bit of an anachronism from the old days, and I'll come back to that. But there used to be something called the Reserve Fund back in the day. And ever since that crashed and burned in 2008, and what we called it is it broke the buck, these things have been treated much more like regular short-term bond funds. So these have faded. Then we've got the ultra short-term bond funds, and we've got CDs. I'm going to zip over to CDs. CDs, of course, they're paying, you can get up to about 5% if you shop hard. But it's not cash. These things are coming with 12 to 18-month lock-ins. And they come with a slew of the challenges. And then we've got the USB, a grade one, for example, and it's just an example, is the Vanguard Ultra Short-Term Bond. That's paying about 4.7%, no lock. Okay? So what are the challenges? With the banks, Amex will not use an entity. Some of the other banks will allow entities, but you're creating an administrative nightmare. And unless you're planning on creating an entity every time a new bank has the best interest rate, I struggle with this option. Other banks have entities, but this is complexity. Reserve funds. Reserve funds are, in essence, basically a variation on the theorem of ultra short-term bond funds. In 2008, when they broke the buck, they essentially vaporized. They still exist in name only, but if you're going to do a mutual fund, why would you not do an ETF? ETFs, lower cost. So, not an option in my book. Yeah, you can make them work. I wouldn't bother. The CDs, I loathe CDs, with one exception. And that is if they're a custodial, buys, sells. So what do I mean by that? If you go to the bank and you buy a CD at the bank, You buy a 12-month CD and it's earned you a lovely 5%, for example. At the end of the year, it's no longer the most competitive CD. What happens? First, unless you cross your T's, dot your I's, they're going to automatically renew the CD. Second, you have to get that bank CD into the correct entity. And third, transferring those dollars to a different bank because now you have a new deal, you have essentially just created a job for yourself. Not to mention your CPA is going to hate you and the bank's going to love you. They use these as loss leaders to make it difficult for you to move. And why would you go from 4.7 to 5.5 with a 12 to 18 month lock? People say, but the principal's guaranteed. Well, it is if you hold it to maturity. However, if you need the money, then you're going to have to sell the CD, and I can guarantee you, unless interest rates have dropped significantly, you're probably going to sell it at a discount. You've probably locked in a loss along with the transaction. And you may not even have that option with the bank. Only if you get it at a custodian does a CD make any sense whatsoever. Because at a custodian, you can cherry pick the banks all day long. And when that thing rolls over, it rolls over to cash automatically. Take the cash, you go buy another CD within your account. That can be Ameritrade, Schwab, Fidelity. So if you're going to go with CDs, go with custodian buy-sells. And make sure you're matching your needs. If you know you don't need it for 1 year under any circumstances whatsoever, okay, let's go find you some CDs. In a rising interest rate environment, even if it's only rising slightly though, I wouldn't want to lock those interest rates. I want to enjoy the ever-increasing interest rates. These things are fantastic. They have very, very, very slight principal fluctuation, normally plus or minus 0.1%. So there's no guarantee of the dollar that you get with the old money funds. But in return for that, you're getting much higher yield that instantly ratchets up with interest rates. And that's a good thing. We don't want to lock it. We can also sell these at a moment's notice or even margin against them if we had some reason to do that. And if we need the money for 48 hours, it might actually make more sense to margin for 48 hours and put the money back in the account than buy and sell the transaction. There's no lock. There's very little principal fluctuation. What is the worst thing that can happen? That happens when you have interest rates being ramped up quickly. In the fall of last year, to an extent never seen before, and likely we're not going to see again, we saw a slightly bigger principal reduction, more than offset by the increase in yield since then. So that money has been returned to the clients in the form of much higher yield. People get married to the concept of FDIC insurance, but what I tell people is if you've got an investment that's made up of T-bills that are issued by the Federal Reserve and you're worried about FDIC insurance, I promise you, when they're not paying these, they are not going to be making payments on FDIC insurance. But in both cases, they're going to make payments, and it's called printing money. And what is printing money? We know what it is. It is inflation. So the guarantee with all these products is only, and to the extent they're guaranteed by the government, is that if we have to, we'll inflate the money away, so you're going to lose anyway. And that's the fundamental problem with cash. Cash will never keep up with inflation over time, especially not after taxes. So there it is. If you've got a need for money to be invested, if it's less than the $250,000 and you don't need an entity, go find something like Amex. It's online. We don't get any money out of the deal. It's a great opportunity. It's easy to pair to your brokerage account if you want to move money back and forth. But for everything else, either use a custodian to buy and sell CDs or buy yourself ultra short-term bonds. You won't regret it. We wish you the best of investing success.